All right, well, maybe it was because it was the first full week back after some holiday weeks, at least for me. That it seemed like this week went a long time, and we kind of finished about at the lows of the week. So we're gonna break down now, like how does this week's market action jive with what we saw in the week between the holidays and then the run up to Christmas holiday, where we had a really good rally. So what, like, is this just a pullback? Is this reverse the course? And we're gonna kind of break all that down to see kind of what our expectations are now going into the rest of this month, going into the rest of this quarter, and potentially really the first half of this year, especially with the Fed now kind of trying to figure out, ramping up the expectations of not only tapering but also raising rates, as well as from what we heard today, the idea that they might start to bring the balance sheet down a little bit to a passive degree, but still, that, and as I tweeted out earlier, like we ended tapering in October 2014. It started tapering at the beginning of 2014, so it took quite a while there, almost a year to taper. We didn't raise interest rates to December 2015, so over a year later we raised interest rates for the first time. And we didn't raise rates again for another year, for a second time. And then we didn't start to reduce the balance sheet until more than 2 years after that first rate hike, which was the beginning of 2018. We started to gradually move the balance sheet down. So that was, from the beginning of tapering, which was roughly beginning of 2014 to the beginning of 2018, where they started to reduce the balance sheet, including rate hikes in between. That's a 4-year period that they took to do that. That now we're shrinking into roughly a 3-month period. And at much higher valuations now than we were during those other periods. So as volatile as things got in 2018, once we had done all three things, things got a little choppy in 2018, the first quarter and then the fourth quarter especially. So as volatile as things got there, valuations are much higher now. So now, kind of what can we expect? So we're going to break that down in our video today, as well as post an idea, our trade idea as usual at the end. So let's go ahead and get started. Today is Friday, January the 7th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, 4 down days in a row for the S&P. I guess, 4 down days. You had, it's kind of reddish there. 4 down days in a row for the S&P. Now, 2 of those days were hardly down days at all, and then today wasn't really that much of a down day either. And in fact, if you look at today's range, it actually came in below average, as bearish as it seemed. We had a below average range and below average volumes, you'll see here in just a second. We are pretty much sitting right on the moving average, just a smidgen below it, 1/100th of a percentage point below it. The intermediate line is dropping, but it's still in bullish territory. So is the market sentiment line, and they're both below 80 now. They were both above 80 earlier this week, and now they're both below 80, but still in bullish territory. Short-term sentiment still oversold. Again, getting that near-term line into lower reversal zone is, that doesn't happen during bullish moves, right? It typically doesn't happen during bullish moves. It typically happens during the bearish moves, as you can see. And so we are in the lower reversal zone on the near-term line, and it's dropping. If you take a look at the NASDAQ, everything looks a little different. If you look at the NASDAQ, it has dark pink shading and a red line. We are below 40 now, so we are actually in bearish territory. This is the lowest level of all the major indexes. Also has bearish short-term sentiment, but we are well 3.25% below 30-day moving average. So well below that moving average, well below the 38% retracement level of this intermediate rally that we've been retracing. Now let's take a look at the Russell. The Russell is kind of in the middle. The intermediate line is dropping too. So is market sentiment, but they are actually low. The Russell has the lowest market sentiment line. In fact, it's just barely above 40. We're just a couple days away from the Russell turning, starting at bearish, but reflecting a market sentiment decline. And you can see, of course, the intermediate line dropping, short-term sentiment extremely low, and finishing at the low of the day, finishing back down below that 23% retracement level of in this case, of the downward move that we've been retracing, because we did go to a lower low here. So now we are retracing this downward move to the upside. Dark pink shading and a red line, just like we see on the NASDAQ. Now, the Dow has been the most bullish. Its intermediate line is actually still in the upper reversal zone. Its market sentiment line is falling, like the S&P, very similar. It's sitting on that 23% retracement of this current intermediate run that we're on. So it's hardly bearish at all. The Dow has really been holding up much, much better, still 1.5% above its moving average. So, I mean, it's kind of like doing its own thing, and everything else is, much more bearish to varying degrees. And the Dow is like, we don't know what you're doing, right? We're doing just fine over here. If you take a look at the S&P now on a weekly chart, now that the week is over with, you can see what this week looked like after getting an overbought cluster last week. With all the lines, including market sentiment line above 80, you got a significant drop in the momentum line all the way down to below the 5th percentile, down to 4.97. Of course, your near-term line is still in bullish territory, but dropping, closing below the low of last week. So relatively bearish in that perspective. Remember, some of these others are more bearish than some of these charts are more bearish than others. The NASDAQ, you can see its weekly chart, much more bearish, sitting on the lows from the last so many weeks. Its near-term line, momentum line also dipping to extreme lows, not quite getting the overbought cluster last week. And then you can see its intermediate line is falling below 80. Its market sentiment is falling below 80. Near-term line's already down near bearish territory. The Russell 2000, it's a little different story. Its intermediate line has been in bearish territory, so it's actually been in this intermediate decline. That's why I say, not right now, the rallies are the pullbacks, not the drops, because we are in a bearish posture now. From a long-term perspective, market sentiment line dropping below 80, near-term line starting to fall a little bit, not as bad of a week as like the NASDAQ has had, but the momentum line also dropping to an extreme low. Very, very neutral range last week, and pretty much reversing the pre-holiday bullishness that we had, getting back below this 23% retracement level. And you can see we are actually below. This is the 30-week moving average here. We are below that, right? Whereas the S&P 500, of course, is above it, and the NASDAQ is flirting with it. And the NASDAQ's only 1% away. And your Dow Jones Industrial Average is the furthest above. It's at 3%. Its intermediate line is actually still rising. In short-term sentiment, it's not nearly as bad. So not nearly as bad of a week. It's the most bullish, but you can see, your SPX is over 4% above it. Your NASDAQ is 1% above it, and your Russell is 3% below it. So all to varying degrees there in terms of bearishness, but it kind of reflects what kind of market the Russell's in versus what the S&P's in, and versus what the NASDAQ is starting, right? The NASDAQ seems to be headed in that direction. Now let's take a look at the weekly chart on the Heikin-Ashi candles, and you can see it was a neutral candle. We got one bullish candle, remember, on that very small normal range, but it was because we gapped up, a lot of the move was up higher, so you take that out, we're still getting neutral candles. The difference is this candle's higher because of the pre-holiday week. If you look at the NASDAQ 100, not so much, right? We got that bullish candle, but now we're right back to where we were previously, still with these neutral 1, 2, 3, 4, 5, 6 out of 7 weeks, these kind of transition candles after that bullish move. And then the Russell, of course, remember, it's on a bearish drop already. So it's already got the red arrow. It doesn't have the green arrow. It never did get the green arrow last week even. Last week was the break from the bearish trend and not really confirming that. Of course, the differential is back to being negative. The PPO is still falling, and we still have a red arrow there. So we're actually still in a bearish decline according to this particular chart. Let's look at the RSIs. RSI is dropping just below the middle of the chart on the S&P. On the NASDAQ, we are now in bearish territory. Just a smidgen, though, just barely below minus 100. It's barely below 40. The Russell 2000, of course, had been below, by quite a bit, and then rallied up to a not so bullish high point, and then now making a new low. So we'll see what what new low that ends up being. See, the Nasdaq had a not so bullish high point too there. The S&P 500 got a little bit better. It actually did get above 100 on the CCI and did get above 60 slightly. If you look at your directional movement index, of course, the index is really the negative indicator is still up. The positive indicator is still up. It's dropping barely. The negative indicator is up above 25. On the Qs, the negative indicator is well above 25. So we are, this is suggesting bearishness, especially with the positive dropping below 20. And then IWM, you can see the positive did drop back below 20, but the negative is not really making a run up higher yet either. Remember, it did have a strong bearish run, whereas none of the others did. So you can kind of see the difference, the variations here. SPY had a bullish trend going, is gone on the Qs. Did not have a bullish trend going. It's been very noisy and still remains noisy, and it's actually at the low end of its cloud. See, SPY is still above its cloud. And you remember, IWM is actually below its cloud and back below the green line and back below the blue line. Had a bearish trend going here. It's been noisy since and has not restarted a new one yet. Let's take a look at their Bollinger Bands. SPY is in the middle of its Bollinger Bandwidth. You take a look at IWM. It's in the lowest quartile of the bandwidth and below the point of control and towards the low end of its 1-year value area. And then the Qs is towards the top end, close to hitting the top end of the 1-year value area, but definitely in the lowest quartile, well into the lowest quartile. In fact, when you look at the Qs with the Keltner channels as well, you can see the Bollinger Bands today broke out of the Keltner channels. That's a green, and we haven't really even started the bearishness yet, like you can see happens here. So the Qs look like they're just starting a bearish run into this lowest quartile as the bands break out, right? We had a little bit of a squeeze play, and now they're breaking out of their Keltner channels, and we're pushing against both of them down to the downside. So, and then finally, do we take a look at the S&P is sitting on its 50-day moving average. The Qs are down below it. In fact, now the 30-day is crossing below the 50. So, and we have this bearish divergence going on here. And then you can see IWM, it's well below its 17-day as well. It's below its point of control, well below its 200-day moving average, and the 50-day still above it. But you can see the more time we spend down here, the more especially with the 30-day down here, well below the 50, the more likely that 50-day. You can see the 50-day starting to speed up a little bit here to the downside. It's the IWM is setting up for a death cross to occur on that particular chart there. So all these indicators kind of telling us that we got these different levels of bearishness. Right now, the Qs have been the most bearish. They're responding more negatively to these rising rates. We'll talk about here in a minute. Small cap stocks are kind of following suit with the Nasdaq 100. So you got that bifurcated market now. They're both headed in the same directions. What you don't have is in the middle, right? In the middle, these kind of industrials, financials, energy, these kind of cyclical areas that aren't necessarily the biggest small cap, like these stay-at-home or the reopening trade, which have been very highly correlated with with a big chunk of the Russell 2000, as well as obviously the mega cap tech areas, as well as the ARK investment type areas of tech. Those areas on the other end of the spectrum they're all bearish right now, and you have the middle, which is the industrials area, that's been holding up better, right? Not necessarily strongly bullish, but holding up better. Industrials, financials, energy especially. I tweeted out earlier. If you don't follow me on Twitter, make sure you follow me here. Just click this follow button when you go to David Settle 42. That you can find my account there. And rest in peace, Sidney Poitier. But if you come down to, I tweeted this out. Where was it? Oh, I guess I didn't tweet it out. I did tweet it out, and this is why no one saw it, because I put an @ sign here. Let me change this. But anyway, so before I change this, if you notice, I tweeted out that XLE's had a great week. This is the relative strength chart of XLE right here. So let me see if I can make it a little bit bigger so you can see it better. Okay, so this is the relative. Oh, you can't see it. Yeah, I can't see it very well. This is the relative strength chart of XLE, and you can look at this week. This is this week. Relative strength of XLE to SPY. Good break, good bullish move. This is a weekly chart, so this is this week. A weekly chart. This is the MACD for the relative strength line, the stochastics, all showing bullish signs, but kind of new bullish signs. But if you see, it had been extremely bearish, and now is starting to come off of these divergences that played out going into the end of 2020, and now a higher low point in 2021. There's still a long ways to go for energy to have any kind of market leadership, right? It's such a very, very small segment of, and here's since the middle of 2014, this is how XLE has performed relative to everybody else. So you can kind of see XLE is going to outperform simply as these areas start to give back their returns. But remember, these areas make up a much bigger chunk of the index than XLE. So if these areas start to give back more and money flows into these areas, it won't be enough. They're not weighted enough to have a positive impact on the index, especially on the Nasdaq 100, where there's not hardly any, if any, exposure to XLE. So and small caps not as much. So when you look at that perspective, it's like, oh, it's not really that big of a deal that XLE is a positive. And it very well could outperform the market even while it declines, simply because as the market starts to change, start to give up some of this extremely high gains, 335% for XLK since the middle of 2014 versus, like I said, a 38% drop for XLE in that same time frame. So the market appears to be kind of rotating and still got this bearish sentiment, and we had a great pre-holiday week and a good start to the year, but it seems like that's all that was, and now we're back to where we were going into the holidays, and so nothing has changed. It was just a kind of a Santa Claus rally that a lot of people were expecting, and we got a great 4-day rally going into and after Christmas, and then, like I said, one more day on the first day of the year, and then almost like it didn't even happen, right? In fact, we're almost back down to where we were when all this bullishness started. So the market appears to be back in this mode, and that would suggest that we have some more weakness going forward into the rest of this month and first part of this year. We'll talk about why here in a minute, but that appears to be what the technicals are telling us to different degrees, and it looks like small caps and the Qs, these two polar ends of the markets that have been doing their own things for so long, are now going together, but in the downward direction. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? Alright, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when we post these videos, so you know when they come up. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. Quick way to give us feedback, or Monday. If you like our videos, of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch if you don't like them. Also, while you're down there, comment. What did you get out of the videos today? What stood out to you? What questions or comments do you have about anything I brought up? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle, @DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching here along with all the other active members on our site, if you're watching here on our website, our blog on our website, come over here on the right, click on some of these things, click on this icon here. It takes you to our Market Outlook live page. This is where I review all old Market Outlook trades. We closed out a couple more today. So the way you stay in touch with those when I get out of these trades is by watching this video. I do that Monday, Wednesday, Fridays at 3:30 on this page. You can view it here. You can chat with other viewers over here on the right. This is a chat that's usually open while we're on the video live. Here's all the old recordings over here on the right. You can also get to it by coming up here to the top of the page. Click on Market Outlook Live Trade Review. If you come down here, you'll see our upcoming classes. If you click on View More, that takes you to our calendar with all our upcoming classes for the rest of this month, as well as over 3 years back. You can see all the recordings, all the archives there. You can also get to this by clicking on Trading Rooms up here at the top. Come down, click on this heart. It opens up this tab. Hit that like button right there. Also click on this thumbs up icon and hit that like button. Again, the more you do that, it really helps us get all of our content out to more of our people. More people that follow our accounts, but because of the engagements, right? The more engagements, the more people this content reaches. That's why we always ask for the likes and the comments and the shares. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching the video. All right, now let's talk about what's driving the price action. This is just today alone. You can see, like I said, QQQ and IWM moving together. Interestingly enough, long-term bonds is right down there with them, as this is a bond story this week, a huge bond story. You'll see here in just a second. You also see that the dollar was down. The dollar, has over the last year or so has been kind of lumped in with the risk trade, and it really struggled, and that gave a lift to commodity prices and gave a lift to international stocks. As you can see, emerging markets really benefits from the weakness in the dollar. Gold, commodities outperformed, even though risk was off. Commodities still did okay, relatively speaking, because of the weakness. I mean, that's a strong move. 0.5% for one day is a strong move for the U.S. dollar. If I were to go back now to the beginning, to the whole week, and let's just go here to the 5-minute chart. So here's the whole week. Commodities end up the best performer. You can, even with the dollar actually being up, so the dollar only gave back some of its, and it was actually up about at 0.2% from the whole week. Most of it coming on Monday, and then just holding those gains throughout most of the week, and then giving it most of it back by the end of today. You can see international stocks started the week strong with the strong dollar and ended the week relatively flat, but outperforming U.S. equities. Look at the Qs down on 4.5%. IWM down 3%, SPX down 2%, long-term bonds were down 4% TLT, real estate down 4%. These are all these very highly valued, right? I mean, if you think about all the U.S. assets right now, long-term bonds, because rates are so low, relatively speaking, again, going back to like the 80s, very, very low interest rates. So long-term bonds are very highly valued. Real estate, as we all know, is very highly valued. And excuse me, U.S. equities, especially tech stocks, very highly valued right now, to the tune of a CAPE ratio that's over 40. Was over 40 earlier this week before Wednesday. So that's a high number that I personally thought we'd never see again on the CAPE ratio. I didn't think the market would be that I wouldn't say dumb, but irrationally seeking exuberant gains again. I thought, we've been down that road before, but unfortunately, a lot of people trading now have not been down that road before. They didn't experience the late 90s, and that's kind of where I cut my teeth in this market. So every very highly valued asset class in the United States, long-term bonds, real estate, and tech stocks, all gave up the most with this increase in and then commodities, which are very undervalued on a long-term basis. If there's anything that is not overvalued, it's commodities. Commodities have been down forever, and I don't know how far back we can go here and still get all these asset classes, because I don't know how much history they have. But the Qs, you can see how strong they are. We don't have V and Q is relatively strong. You can see it's pretty much as long-term bonds. Gold is up high as well over the course of this 10 years? Did I say 15 years? So that's coming pretty much since the beginning of 2007, going into that last year before the for that financial recession there. So, but look at commodities. Commodities are down still 8%, or this ETF is down 8%. They really peaked in the middle of 2008, and they're way down from that point, way down. So they are very undervalued, and so you saw the script reversed this week as things change in terms of interest rate expectations. Look at TLT dropping below its 200-day moving average pretty sharply, relatively sharply. IEF you notice is actually way more below its 200-day moving average. This is the ETF that tracks the 10-year note, so it's got new 52-week lows. The MACD is, we're way below the 8-day moving average. So I expect that we should get a really big bounce in bond prices next week sometime. Not to a new trend, just to get back to the 8-day moving average. So don't be surprised if we get something, this kind of a move that just gets us back up off of these extreme lows, but doesn't necessarily, like this, for an example, that doesn't necessarily change the trend, but at least gives us a bounce up. And again, what kind of, if bonds make a big move up, then that's probably not the best thing for equities. Though equities, as you saw, is relatively low too. The dollar finally breaking down kind of more today than it has in a while, since that last day of the year that was kind of more window dressing. As you can see, it was quickly erased the next day on the first day of this year. But today's move, not the last day of the year. And so today's move, you can kind of more bearish than what we've seen, well below the 17-day moving average, which the 8-day is also below. The 8-day is below the its moving average. So we are in kind of bearish divergence mode, and there's a big gap here between the 50 and the 200-day for the dollar to fill. So there's an opportunity for the dollar to be weak. Remember, the dollar is a risk asset class right now, not a safety trade. The euro is a safety trade. And you can see, look at how the euro did today. And it's, again, big gap there to fill between the 250-day moving average if we start a new bullish divergence here. If you look at the dollar against other safety trades like the yen, you can see kind of coming down from that low point there. And then the dollar versus the franc, another safety trade. And the reversal on that point too. Again, those are two other typically safety trade currencies. In fact, if I look at the currency comparison chart here just for this week, let's go to the 3rd through this week, and we'll go to a 10-minute chart because it's got a lot more data. It's got all the 24 hours worth of data. The dollar, you can see, was up against everybody going into this week. Going into today, it was up against everybody, including the euro. But now, let's look at just today alone, and you can see the dollar was down against everybody, and down a lot. And the safety, you can see the franc, the yen, sitting right there with the commodity currencies. So, and the euro, one of the stronger ones. A lot of these, Swedish krona, Norwegian krona, South African rand, Mexican peso, you got your Canadian, but outside of that, the euro was the strongest performer. And so it kind of goes to show again, that's where the strength, in my opinion, the strength of the currency market will end up being is in the euro. And if that's the case, again, with the dollar having been a risk on trade over the course of most of this past year, if we start we're starting at worst for the euro, this bullish, this bearish convergence on this. At best, if we get above the 17-day moving average, then we can make, and get back above this 200-week, 17-week, 200-week moving average, and we can get back to being bullish and essentially just back to the levels we were just a couple of months ago before November started. Not very far away. All right, the other one other thing too that is a reflection of extreme risk appetite, in addition to ARK, is Bitcoin. So this is the futures contract, which you can see now has a few 200 weeks moving averages here. It's way down there, and we are just breaking below, and we're just starting a bearish divergence. So this is a little different than this drop where we were just hitting the 50-week exponential and started, and the MACD histogram peaked there on that decline. Then the MACD bottomed out, over here just a few weeks later, and then we bounced off of that and got up to a new high, and a lower high point relative to these oscillators. This is a little bit more bearish, and there's a lot of room to the downside, down to about 20,000. Again, a sign of risk aversion, like extreme risk aversion. And then you look at ARK Investments, another sign is already below. It's already filling in that gap, and this week, really bad week, breaking below the value area the past however many years has been in existence. and you can see the lack of volume below the 62% retracement level. We've already been in this strong bearish divergence, and not a lot of support. This is really the last layer of support, which we closed today at 84.82, and that level is about 82. So breaking below that, there's not very much volume for it to come all the way back down to pre-COVID levels, which again would not be a good sign for risk appetite in general, especially on that end of the spectrum. All right, now let's look at how the sectors performed today. And as I mentioned, energy, financials, they're kind of in the middle, right? They're not really on that strong, small cap end of things. The Russell 2000 is kind of more industrials, materials in this area. It's also not, large mega cap tech, which is XLK and XLY. So they actually did okay. It's kind of like, the only areas that's not really in the spotlight right now. And if we were to go out to the full week, you can see they had a really good week. Energy up 10.5% this week, and I showed you why. Energy's been way down. It's still got a long ways to go. Financials up 5%. Its biggest move was on Tuesday, and then kind of holding those gains. And then look at the drop in healthcare and real estate, and then technology. They're big weekly movers to the downside. When you look at the 12 grid for these, you can see how we're starting to roll over on the. We just haven't been this kind of bearish on these big sectors for so long. The pink shading, dark red lines here. But look at energy spiking. Look at financials spiking. Materials and industrials already had a good move. Did not spiking on this go around like those two are. And look at the safe haven areas pulling back to moving averages after already being relatively bullish and overbought. And then healthcare, you can see now more than all of them. Healthcare and real estate more than all of them. Let's take a look really quickly at the DMI for energy. Look at that jump up there. Again, we haven't seen that big of a gap since this bullish move here. And then look at financials too, and you see something very similar too. This is the biggest positive directional index that we've had, going all the way back to over here when we were, so bullish in those those smaller sector areas. So a big jump higher in those areas, and not so much in anything else. So under 30 on on industrials, under 30 on materials, real estate getting back below 25, technology getting easily getting below 25, discretionary getting back below 30. I'm looking at the positive. Staples, which has been so bullish, heading lower finally. Utilities also below 25, and then the communication services below 20, right? Even more bearish than all of them. So the rotation is coming out of these higher valued areas and definitely going into much more lower valued areas. Now, energy had a good year. Let me just kind of go back here really quick to last calendar year. So we'll go to 2021. Energy did actually have a good calendar year for 2021. It was the best performing sector. Real estate was the second best performing sector. Financials did really well too. Technology was okay. It was better than average, and everything else kind of really good returns, right? 26%. That's for 2021. But going into that, you can see in 2020, financials and energy were really weak, and technology still was strong with XLY and XLC. Look at 2019, and you can see that technology was very strong. Financials did okay, but energy did not, right? It was by far the weakest performer. In the year, the S&P was up nearly 30%. Energy was only up 4%, right? Look at 2018. It's 18. 2018, you can see energy was, the market was down 6%, really at the end of the quarter. Financials and energy were the biggest losers, and technology actually outperformed, down a little bit, only 3%, but held up pretty well, and discretionary did too. That's 2018. 2017, you can see, and the market was up 20%, and energy was down 4%. So, in 2017, at one point in time, energy was down over 15% for the year when the market was up nearly 10%. And technology was up 32%. And then there's the rest of your safe havens lagging behind. So, really, 4 years in a row where this technology just kicked butt compared to energy. Here's those 4 calendar years. Technology up 170%, discretionary up 100%. The two biggest outperformers over the market. Everything else lagged behind the market, but still decent returns for 4 years. And then you look at energy, which was down, is still down 50% over the course of those 4 years. Before one good year in 2021, or excuse me, 17. We'll keep it there, 17, and then one good year in 2021, which now has put it only down 26% over the course of this 5 calendar years, whereas energy is still up 260 and discretionary up 150, over 150, when the broad market itself, all said and done, is up 112. And those are the only 2 sectors pulling the S&P up. Everything else lagging, though lagging at pretty decent returns for a 5-year period, normal. It's just the technology is killing everything, and energy struggling. So, and financial struggling too, pretty much until this last little hurrah in October. It was a pretty poor performer too. It was barely positive at all when the market was up, 45%, and XRK was up 130, at the lows of that September pullback. So it was barely positive. And then it started this little rally from that point. And actually, that's been one of your better performing, since that Halloween low point that we had in 2020. Since that Halloween low point, you can see energy and financials have been your best performers. But you see why? Because they've been the suckiest performers out of all of it. And the market's up 44%, and your safe havens lagging, but that's why. And so, are they going to outperform this year? They could very well outperform XLK and XLY. The question will be whether they will outperform XLP and XLU and other safety trades, especially towards the beginning, right? Over the first 3 to 6 months of this calendar year, as the market starts to figure out how to behave, how to function during an environment where interest rates are not at 0%, and during an environment where yields are rising, and there is no quantitative easing, and the Fed's balance sheet may actually be reducing, not just flat, but now starting to reduce to at least small degree. All right, so for our trade idea of the day, I wanted to take a look at MGM. MGM has been kind of interesting. It's been part of this reopening trade. Of course, it was pretty bearish. Hit this oversold cluster back in December. It's been rallying ever since. Had a good pre-holiday week, flat like everybody else. Good beginning of the year like everybody else. Down early this week like everybody else, but not down today. And actually holding up pretty well, 4% above its moving average. Got the intermediate lines in bullish territory. Even if market sentiment's falling below 40, at least your intermediate line's still in bullish territory. It's not quite breaking down yet, at least. When you look at its directional movement index, there is definitely no directional trend going on at all. The ADX is very low, lower than it's been in a long time. So a very low ADX. The positive and negative indicators are both between 20 and 25, so no clear direction there. Very noisy chart on the trend strength indicators here as we trade around the cloud, the Ichimoku cloud, so no trend developing here. You can see the Bollinger Band width has been relatively high. It's starting to, so you can see it's relatively high. It's been higher than most of this year, but we're sitting in the middle of the range. You would expect that bandwidth to start to falter a little bit. If you take a look at the Keltner channels, with it, the bands are outside of the Keltner channels now, so that would suggest that we would switch to a red, where that's a squeeze play whenever the bands come inside of the channels, as that bandwidth starts to come back down again. If you take a look at like the RSI and the CCI, they're both in the middle of their charts, not really trending, not breaking out above 60 or below 40. Very neutral from that perspective. Neutral though with a slight, bullish bias to it, because as you saw the market forecast, the green line, the intermediate line's in bullish territory, but we're also trading above the 8-day moving average, which is above the 17-day, and they're both above the 30, and all are rising. At worst, we're in this bullish convergence mode right now, and we're at the top of the 1-year value area, looking to try to maybe even get above that. So so not so bad, right? If we're going to be neutral, it's better to have a slight bullish bias because we grind higher than a bearish bias because you can really break down pretty hard. And so what we decided to do on this trade was to come out and sell, do an iron condor spread. So sell a put spread at the 20 deltas, mid 20s. So sell the 41, buy the 36. I went $5 wide because over here I had to go $5 wide. I sell the 50 deltas, buy the 55. Position size for normal position size there, and you can see my break evens are set on my chart here, right at one of them is at that point of control for the 1-year chart, so very strong support level there, and then the other is above the high point for the 52 years. So we'd have to start pushing the new 52-week highs again to get up to that break even. So I got a really good range to trade within. We do have earnings that are going to be coming out here after January expiration, but I got room for it to work in and see how it will trade. You can see some of these earnings, it's very easy for it to stay within the range. Since we're not really getting a big move going into it, that's the kind of move I expect coming out of it. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Click on that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your weekend, everybody, and we'll see you all on Monday.